Welcome to Global Money Talk, brought to you by SamProTV. Greetings to our viewers from across the U.S., Korea, and around the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm Remy Blair, and joining me on this Friday morning, live at the New York Stock Exchange, is Tai Wong, independent proprietary trader. Tai, happy Friday.
Good morning.
Good morning. What a week it's been.
What a week it's been. The UN is wrapping up here in New York. It's been a big week for China, and it's World Tourism Day. So, I guess tourism is good. It gets people, different countries to mix with each other, to see each other as people. So it's a good thing, tourism. I like tourism.
Absolutely. And speaking of tourism, let's start out by looking at where markets are right now.
Yes.
Because on this Friday morning, on the heels of the latest U.S. economic data, we saw PCE, which is the Fed Reserve preferred gauge for inflation, coming cooler than expected. And we saw straight out of the gate the Dow Jones Industrial Average soar. And right now at this 11 o'clock hour, we are seeing the Dow Jones Industrial Average up by triple digits, or nearly 0.9%, and that is significant. But meanwhile, we're seeing the Nasdaq Composite Index nearly flat on the session after opening higher, and the S&P 500 is extending gains higher by 0.2%, and this does come after a record high yesterday. So what a way to kick off today's session before we head into the weekend.
Yeah, this is the PCE, core PCE is the Fed's preferred gauge of inflation, or at least this Fed. Someday it'll be a different gauge, but right now it's this gauge. And month on month, it was only up a tenth. The consensus was 0.2, and year on year, which typically month on month, I like it better because it's more recent, but Chair Powell has said we like to look at changes over time because it does take some time for things to get through, and we don't want to react to a month. So year on year, it was 2.7%, which is still on consensus and still above where the Fed wants it to be. But I think this report will make them pretty comfortable about inflation. So the futures moved a little bit more towards 50 basis points versus 25 at the November meeting. It's still around 55, 45. So I think the market still isn't sure. But what this says is the Fed can really just pay attention to employment. That's what they're worried about. They don't want employment to get any worse. But inflation seems pretty well behaved. 2.7 over time, probably a little bit too high, but that's I think that's really on the back burner right now.
And you bring up an important point because jobless claims figures yesterday, we saw a decline in both initial jobless claims as well as continuing claims. And of course, next Friday, we get the big jobs report for the latest month, non-farm payrolls, unemployment. But we don't have a Fed Reserve gathering meeting or rate announcement in October. The next gathering and meeting will take place after the election on November 7th. So we do have some time to assess what the economic situation is here in the U.S.
Yeah, so I think the employment report's really important. We also get JOLTS next week, which is job openings, which is, again, something that Jay Powell says, we watch. And that has gone from having 2 jobs per person looking for work, about a year ago to about 1.1 or 1.2 now. So it's in balance. They don't want it to get any worse. But this employment report will be important because it'll be one of the, I think they will actually see one more employment report before the next meeting. I'll have to check on that. But they want to see how healthy employment is, and just so they know whether they want to go 50 or 25. But Jay Powell has a speech next week as well, and the market will pay attention to see if he's dropping any clues. But we're still pretty far away from the next meeting. So as we get closer to the meeting, that data will move the markets more. Right now, it has an impact, but a little less.
And you mentioned what we have coming down the pike next week. So next week does mark the beginning of the month of October. We still have one more trading session for September before the third quarter wraps up. But a lot is on the calendar next week, in addition to jobs report, Fed minutes, as well as Fed officials. We've been hearing from plenty of them this week, so it's very interesting to hear their consensus, especially when hearing from Bauman, the one dissenter from the latest meeting.
Right, very much so. So this is the time for the Fed to come out and talk about things. They have a lot of time until the next one, which is important. And what's also important is we mentioned that October 1st we have the last, the vice presidential debate, And this election looks like it's really going to come down to the wire. All the focus is on the half a dozen or so swing states. So that could matter if there is, I think, a specific a big change or something unexpected happens. If one vice president's candidate does a lot better than the other one, could move the needle a little bit, and that little bit might matter. Because if you remember, the popular vote differential might be 3%, but in the last election, if you move about 75,000 votes the right way in the specific counties in each state, that would have changed the election. So we're talking about potentially 50 to 100,000 votes in the right states that could flip the election. So this will be very closely watched.
I'm sure you and I will be talking about it on Wednesday morning after the VP debate on Tuesday evening, 9 p.m. Eastern Time here in the U.S. And of course, we'll be taking a look at the election and some of the issues later on in today's segment. But before we get to that, I do want to talk about Costco. So they reported their earnings yesterday. We heard from executives in the earnings call. And because you mentioned October 1st, we'll have to wait and see whether a strike with the workers, dock workers, and the longshoremen group will be reached or not, because they addressed that yesterday in the earnings call for Costco, saying that they had been anticipating supply chain disruption ahead of the holiday season. So it
doesn't look like they will settle this strike. I don't know how long it will take, but it has been well telegraphed. So hopefully, everybody who needs materials that comes through the East Coast have already gotten it or are figuring out ways to do it. There will be an impact. I mean, it's $3 billion of stuff going through these ports every day, so it's hard not to have an impact. But we look at Costco this morning, they'll say it's down substantially, 1.5%, despite having a very good earnings report. The report said they were getting more foot traffic, so people were spending a little bit less per visit than they had before. But I think what it says is Costco has gone up 37% this year. So I think the valuation there is a little stretched. Costco is a great company. We love it. I mean, I love it. But they don't grow. They can't really grow that dramatically because their margins are 11 to 15%. And a lot of the money they make is actually from memberships as well. So valuation's a little stretched there. I don't think it's going to collapse, but when you go down on a good earnings report, it suggests that we may need some more consolidation or maybe a little pullback here before it rises. And it's a good time to talk about the overall stock market, which feels like with the Fed cut and the big boom out of China this week, and they added to it in the past day, where they cut the 7-day reverse repo rate from 20 basis points to 1.5 from 1.7. So that's the last strike for the monetary policy folks for now. But that's really those two things have really, I think, made equity investors very, very comfortable that we're going to have a grind up higher. And the other thing I saw this morning was Bloomberg reported that U.S. holdings of ETFs have now hit $10 trillion. 10 trillion, that's a big, big number. Just for, so you can compare, it was only 1 trillion 14 years ago. And at $10 trillion, if you figure about 35 basis points on average for fees, that's $35 billion in fees that U.S. managers of ETFs are taking in.
Not too shabby.
Not too shabby. But one of the reasons why people do actively managed mutual funds and sort of actively managed hedge funds, sometimes really struggle because having ETFs where the average citizen can easily invest in almost anything. So if I wanted to invest, and I do, in the 10-year bonds, it's a little tough to buy 10-year bonds, but I can buy the ETF UTEN. It's basically the 10-year bond ETF. So really easy for me to manage. I don't have to worry about taxes because it's all in my Schwab statement. It's really amazing, and I think that's why all the flows are going in there, and you could see stocks just grind higher for the balance of the year.
And given that we're about to wrap up the third quarter, it'll be interesting to see the total amount in terms of U.S. ETFs as well as global ETFs and what regions are seeing the most growth when it comes to these types of funds.
That's absolutely right. I mean, the idea of the flow that comes in, especially to Vanguard, the S&P 500, which started, I mean, these ETFs started in 1993. They really didn't get popular until probably around the year 2000. You know, all the money that comes in, remember August 5th, that major collapse? The market bought the dip. So it's really hard to fight against that market. I think it's almost $700 billion have gone into ETFs already this year, and a lot of that is in the indexes.
And because you mentioned what we saw from Asia this week, I do want to shift our focus on over to Japan. So if we look at the FX markets, you and I talked about it.
Right.
We saw the yen rally strengthen over 1%. So this is very interesting because we were talking about the ramifications of the results for the LDP heading into this weekend. And both of us woke up, we looked at our phones, and we saw that yen gain, and we're like, oh, I wonder what happened. So what do you make of the implications for this?
You know, late last night, New York time, dollar yen was, I think, might have gotten up to 146. I want to say. What was the high dollar? Yeah, dollar yen high was 146.50 late last night, and I think the feeling was, and it was specifically that sitting Prime Minister Kishida, I think, you know, group was going to vote for Sanae Takeichi, who's the Abe acolyte, who's sort of very kind of a hawk, but wants to keep interest rates really low. And the feeling was she would really lean on the Bank of Japan not to raise rates anymore. So she was she wasn't the favorite, at the beginning of the week, but she sort of became the favorite towards the end, and that's why people were selling yen, buying dollar yen, because if the BOJ doesn't hike, then the carry trade will have more legs under it. So when we woke up this morning, it was a 142. I'm like, she must have lost. So indeed she did. She lost to a former defense minister, kind of an outsider, named. Remind me of the name. I can't remember the Japanese name.
His name is Shigeru Ishiba.
Ishiba, right. So he's been sort of an outsider, and but he's in terms of humble. Wants to have an Asian NATO, which the Americans have said, well, maybe not a NATO, just a sort of security arrangements, because the idea of an Asian NATO, probably makes the Chinese angry and nervous, although nobody's going to invade China. Last time it happened, it didn't go well for anybody. So nobody's invading China. But NATO, and then having sort of a combination where an arrangement where everybody has to come to the aid of somebody else might make people nervous. But anyway, he's considered an outsider, but he wants to continue with how the Japanese economy is going, and he's probably not going to lean on the Bank of Japan. So that was a big move in dollar yen, which was quite remarkable. So I guess that election was really close, though maybe not as earth-shattering as the as the U.S. election, unless you're trading dollar yen.
Absolutely. And Tai, before we move away from Asia, I know that we had some charts prepared when it comes to China.
Absolutely.
So let's do a brief review of China. So the major injection of stimulus from China's central bank, we saw it shore up the equity markets.
Absolutely.
And when it comes to that market, we know that they're about to head into a holiday next week. So let's start out by looking at the chart.
So this is the benchmark Shanghai index this week. Look at those bars. I mean, they've essentially erased all the losses for this year inside of a week. And it was sort of, they started on Tuesday. You saw the Tuesday bar, and then Wednesday, and then I think there was a little. Actually, Wednesday I think was the quiet one. Then erupted Thursday, and then finished the week really strong. Appaloosa Fund Management's David Tepper said, "I am buying anything with China attached to it." And I have some guardrails in China, he said, but he said I'm actually going to. Take some of those guardrails off, because he's really excited about China. So when you see a chart like this, you do not want to get in front of it. You do not want to fade it. Whether or not you believe that all the things that the Chinese have done so far will really turn that economy around, I think that's up for debate. What's not up for debate is I think all the monetary stimulus is going to be good for markets. As a matter of fact, People's Bank of China can't legally buy stocks, but they've said we've put up a lending facility where you can borrow money and buy stocks, like banks or insurance companies. So functionally, they're buying stocks. So I think the trade here, if there's a dip or a consolidation, you may want to put a little money in here. So let's go to graphic number 2. So just for so we can see. Taking a step back, this is a 5-year chart, and at the far right-hand side is what's moved so far this week. So each bar is a weekly chart. So you can see that it's gone up a lot this week, but valuations are still quite low given where they were 3 or 4 years ago. So there's a fair amount of opportunity in China. If you're a stock picker, you can pick the stock that you want. I'm not really an individual stock picker, so I'd like to get in on this index. I mean, I could buy it here. I'd like to buy it a little bit lower if I could, but it looks like there's an opportunity for HSBC thinks it's another 10% before the end of the year. Could be more than that, but there's some opportunity here. The fact that you missed this week, I mean, it was a little tough. Didn't know how big the bazooka was going to be, but this is what is lifting a lot of markets. Base metals, it certainly helped gold. The gold is starting to consolidate. I think it'll help the U.S. markets, and it's actually also helped Bitcoin quite a bit.
Oh, yes. Speaking of which, Bitcoin did soar above that 65,000 level today, and this was even before the PCE data.
Right, and it looks really good because I was concerned about Bitcoin, and I'd shown that chart quite a number of times where it was in a downtrend. We're getting lower highs and lower lows. Well, we've clearly broken that downtrend now, which would be good for Bitcoin bulls. I don't know if we are going to get back up to 73, 74,000 highs that soon, but certainly we're out of the downtrend, and we may be consolidating, and hopefully if we continue to get we will get Fed rate cuts, but if it looks like it's going to be another 50, if the stimulus plan out of China, the fiscal stimulus plan, as it comes to fruition, looks good, you can certainly see that's going to help Bitcoin because it's going to help all other risk assets, and it'll change the mood where instead of selling the pop, you're buying the dip, and that's a mood that's pretty important.
Yeah, and you mentioned that 73,000 level for Bitcoin, which we haven't seen since earlier this year in March. And a technical level that people have been watching for Bitcoin, it was that golden cross. And we do seem to have crossed that today, given the advance in the crypto major. So we'll keep an eye on what happens next week and the coming weeks for that cryptocurrency, because year to date it is up by nearly 50%, and that is a considerable gain, right?
It is a great year, don't get me wrong. Just looking at some of the other big ones, Ethereum is up, but still sort of in a in a sideways range, not bringing in a lot of excitement. But the other one, the Solana, is now pushing up against recent highs. So we can get through the recent highs. Solana might have a little bit more legs under, a little bit more of a run. But right now it's still mostly Bitcoin focused, as most of the crypto world is. Bitcoin is still really the benchmark, by far.
And because it is World Tourism Day, let's move on over to Europe. So Spain and France have been in focus this morning, and this does come after inflation figures came out, and we did see that inflation plunged, fueling expectations that the European Central Bank could also be on track to cut rates eventually.
So the European Central Bank, wasn't expected to cut in October. They were expected to cut in a later meeting this year. I think it might be December. But the inflation data that came out in France and Spain were so bad today. Well, so soft, I should say. It's probably good for consumers. 1.5% in that range for both countries, substantially below where the people were expecting it and where they were the previous month. And it was such a sharp move that an October rate cut was just expected by 25% consensus last week. It's up to 75% in a day. So that's a really big move. If we get some more weak certainly the doves on the ECB will push for a rate cut, and we get some more soft data out of the ECB, out of Europe, the Eurozone, we could certainly see the ECB move a little bit earlier than expected, which will help the dollar a little bit. The dollar's been under pressure, trading at the very bottom of its range, although relatively resilient. That might help the dollar index hold itself up, just because euro is such a big part of that index.
So that is something we'll keep our eyes on, especially as we're seeing central banks around the globe begin their easing. So before we move away from Europe, I do want to say that it's been interesting to see expectations for the Fed Reserve. I know that you mentioned this at the top of the hour, but there are expectations for more cuts from the Federal Reserve, and the bigger cut that we saw last week, there are expectations for a bigger one in November. But we'll have to keep an eye on whether 25 or 50, that balance changes next week.
Right. And it's definitely in the mix. So I don't think they have to, the Fed has to call Nick Timiraeus again and say, hey, let's move the market expectations. If it's in the mix, they just don't want to, they don't really want to surprise the markets.
Of course.
I sort of disagree with that philosophically, because I think the central bank needs to say, we're the central bank. We see more things than you do. We understand more things than you do. And a little surprise, I think, is healthy. You get the market really used to, they'll never surprise us. I think sometimes, from time to time, a surprise is good. Look at what China did. They surprised the market, in a big way, and they got a big impact out of it. If they slowly let things dribble out, would they have gotten the big bang that they sort of did? Maybe not. So from time to time, I think you want to retain the capacity to surprise.
And speaking of surprises, Tai, it is a U.S. presidential election year, and the countdown is on to November 5th.
Yes.
Hard to believe, but since next month is October, it means we're inching closer to that November 5th date. And here in New York, we have been seeing a lot of delegates from countries around the world, different nation states, and they have been here for Climate Week. So I do want to shift our focus to politics and electric vehicles. So we all know that demand for EVs in this country have been lower, but what has Harris been doing when it comes to this EV push?
So what's pretty interesting is the Biden administration has been pretty aggressive in trying to push the low carbon EVs. And remember, Governor Harris is from California. So they came to California has the strictest emissions it has for a long time, of any state in the country. And they're such a big state that sort of the rules they put in place is typically followed by the major car makers, as well as the rest of the country. And some of the more aggressive things that they want, I think the administration has a target of half of this cars sold in this country to be, EV or non-carbon emitting by 2030, maybe 100 of them by 2040. In fact, California wanted 100% of them by 2035, which for the rest of the country is, there's really very little chance of that, because the infrastructure required to produce the charging apparatus for this many cars, it's going to be very difficult, particularly for trucks. You've got all these 18-wheelers. We're a very trucking country, getting stuff from city to city. If you had to charge a big semi, it would take a long time, and you would probably need places that would require the power that would supply a small city. So what's interesting is Vice President Harris is walking that back. No, we don't really want vehicles to be to EV adoption to come that quickly. And she's thinking about the Midwest. She's thinking about Michigan, and it tells you that this is climate. It's been a big thing for the Democratic Party, that she's walking it back. It tells you how close this election is.
And we know that when it comes to climate as well as EVs, it's a highly political issue, and one that voters across the country are paying attention to. So we'll dive deeper into EVs in the coming weeks, I'm sure, given everything that's happening with the campaign. So Tai, it has been a pleasure this week talking about everything happening around the globe when it comes to markets. So have a great weekend, and thank you so much for all of your insights.
Exciting week next week as well.
Indeed. Thank you so much, Tai. And coming up next, we will be joined by Dan Ha, partner at Karani Asset Management. Don't go away. We'll be right back.